Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, April 26, 2022. I said if I saw anything interesting, I'd get one out to you guys today after the close. And I can tell you what, we've got now both Microsoft and Alphabet out of the way, so that only leaves, as far as the FAANGs go, Facebook, but Facebook's already been decimated. Like I told you, that stock's already down 50%, and the chart looks like death. So that really leaves Amazon and Apple. Of course, they're selling down. But here's what I wanted to point out. So far, those flags, a couple green candles. Remember, we had that consolidation today. I laid out a potential bounce trade intraday. The first one popped, minimum target was hit. I'll go over that in a second. Then the second one just didn't pan out. We took out the recent lows. So the market does not like what right now. I don't know if the calls are over yet or even be honest, even started. I know the numbers are out, but they definitely don't like what those big names, Microsoft and Alphabet, were selling as far as how their earnings came in. And again, I think it was Microsoft. I'm pretty sure beat with there's different metrics, but it looked like mostly beats. And again, it just doesn't matter. Here's what they look like after hours. Let me go to a 1 minute chart. Well, the ones that reported were Microsoft, all over the place, and in the better of the two, it's actually clawed back some of the intraday gains, but you can see it's still on the day down 2.81%. This is the wild ride you get after hours. These white candles, this shaded area. So you popped up, then you popped down, you went up, and down. And then Alphabet mostly down, and it's staying down. It's about 7-8% down. So, all right, in a nutshell, let me just go back to QQQ. I'll get to the short-term chart. Let me just get those over with, the short-term charts. All right, so that was active trader stuff I threw out. Where was it? On the NQs today and ES and everything else. Here's that same chart. I'm going to zoom in a little tighter. When I did the video earlier today, I gave you a minimum target right here, and that one was hit perfectly. That was in that video actually. When I was doing it, we were right here, and I said it probably wouldn't get out to you in time, and it was published. We were still right down at those lows with that. We had a little 5-minute divergence there, and we popped. So that was a quick trade. Hit the first and minimum target, pulled back. Took out this downtrend line later in the day, but just never failed to rally up and even take out. Of course, once you hit one level, it was resistance before, and then the FAANGs reported. And so this is where, like I said, if you're an active trader, that was the recent lows. We had multiple reactions there. They took it out right around the close today, a little before the close actually, and about 1300. So that's now resistance. Again, this is there is still always a lot of post earnings noise. You got the conference call, and then sometimes these after hour drops or even rips are faded. But this time around, it doesn't look good. Let me just say that. Let me go back to a 60-minute chart here of QQQ. And I'm saying it doesn't look good for the bulls. Looks good for the bears, or those of us that are short. NQ, that's not the one I wanted to show you. I want to show you, let's just look at QQQ for now, and let's go back to that 60-minute chart. Here we go. All right, so this is the one put out this morning. Also covered in the video yesterday. I showed you a very impulsive move down, bear flagpole, and so far, again, because of earnings, we had that consolidation, everything paused. But now we know those earnings are out of the way. So we've got now 3 of the 5. Well, you count really 6. I call it now FAANG plus T. Tesla's so big, it's kind of in that group. But even Tesla's been selling off since earnings lately. This is it. As I talked about, they're taking the market leaders out, tying them up to the post, putting a cigarette in their mouth, blindfold them, and then the firing squad's taking them out one by one. What do I mean by that? Well, here it is. Apple, of course, the strongest of the lot, and but the weekly chart tells me, what the rest are telling, what the market looked like before divergent highs, and eventually you get enough of the rest of the market leaders break. It's going to bring Apple down no matter what they report. And so there's Apple, still needs to break that trend line. Look at Apple also clinging to the 40-week exponential and simple moving average right now, same as the 200-day moving average, and had a successful defense there. It's been walking up. That is a great level on Apple and a lot of tech stocks, those 200-day moving averages. And so, Apple again reports Thursday after the bell, and we'll almost certainly know by the end of this week, especially going into next week. But this breakdown appears to be happening now. That's why I wanted to get the video out, because now we have, there's a handful left, and their charts just don't look that good. We're seeing one stock after another, one sector after another breaking down. And I'll continue to say what I've said. This looks like early stage bull market action. I turned on quickly CNBC to just listen to see how those earnings came out, and they have a flurry of analysts on there, fund managers, and it never fails to amaze me. They're still bullish, still maintain the majority. One guy was a little bit bearish, saying we'll probably see more downside. The rest were holding their QQQ position, saying they plan to add, this year will be a great year to add to tech. And one guy reiterated his much higher target on the S&P 500. So who knows? They're going to be right, or I'll be right, and they'll be wrong, or the other way around. We'll see what happens. But I just wanted to again show you that flag's playing out. Oh, all right. I was talking about the market leaders. I kind of got off on a little tangent there. Microsoft, there it is, down. Already 24%. Again, holding up relatively well after earnings, but still down over 3% on the day, and also down 25% now, a quarter. It doesn't look like it when you use log scaling, but that's a 25% drop, because that's how log scaling works. So a quarter of the value has been wiped out since the top, and according to my my analysis, it's got a lot more to go. Long way to go. I still think this is early stage bear market action. But that one's not been really completely taken to the shed, but it is now below the 200-day, 40-week moving averages. And again, turn off all the lines, and you can see that that usually doesn't happen. These were all the biggest corrections in the strongest bull market, I believe, in history. It'll go down as, if you consider it, from 2009. And the only time you're below that are these severe, major corrections. You're briefly below those lines, and then in a bull market you usually recover them after a few weeks. So this time we broke it, back tested, and then you roll back, and then you look at the previous bear markets, and that's what happened there. This was 2007. You took out the 200 days / 40 weeks. We're looking at a weekly chart. You back tested about the same amount of time later, a couple months later, you back tested, and then boom. So if that's where that mall map is when you walk into a shopping mall, that you are here, that's what it looks like to me. We'll see. And we're still at a pretty important level. The week isn't over. You still have other things. So if you are bullish or looking to go long, it's simple. To me, it's simple. If these lows get defended, and I talked about the false breakdown scenario recently. Let me again, this right here, these double bottom lows right there, boom, boom on QQQ. See, we're taking it out after hours. And that's also part of that flag. Now, again, what I said earlier today, it may still hold true. You may see some choppiness here. You still have a lot of big companies reporting this week, culminating with Apple and Amazon on Thursday after the close. But if the market doesn't like them, that kind of plays into the nature of a flag. So we could get that straight down drop now. And remember, this measured target, the way it works is the charts are what I call stacked. I make a lot of terms up in trading and investing that you're not going to find anywhere. And so when I say the charts are stacked, so this is a simple 5-minute chart. So if that bull flag plays out, it's going to take us down here. Now what's that going to do on the daily? Go out to the longer term, it's going to clearly put in the rearview mirror that support level where the Qs had that double bottom low, the S&P 500. Also, let me back up here. Had that major reaction low right there. That will be taken out, and then you go to the small caps, and you have the IWM. You have the recent trading range right here, and now boom, you're going to take out that as well. And so by with the charts being stacked, something that occurs on a short-term chart, a 5 or 60-minute chart like I just showed you, if that plays out, then that tends to or has the potential to break down and trigger things on these longer-term charts, and they're more significant. A 60-minute chart is a chart you're typically is going to give you an idea on a trade, whether it's a bullish or a bearish chart pattern or setup you trade, lasting days to week. It's one of my favorite swing trading time frames. But then what happens there, if that plays out, then it carries all the way over to the weekly and potentially the monthly charts. So, so another way to look at it, here's that big 20 period monthly exponential moving average. Today's April 26th, so we've got only a few more days left in the trading month, right? So if we have that more downside, and that 60-minute bear flag pattern is going to play out and hit the measured target, that's going to take us down over the next few days. And let's see, so the last trading day is Friday. So that would take us down till after Apple and Amazon report. And if it takes us down lower, it's going to come down here, hit that target right there, the 299. It should hit my first target, and that would also coincide with a bounce there. But that bounce, again, we're probably going to park the month below there and get a sell signal on this big monthly 20-month moving average with a solid red candle printed below it. And so then at that point, what may happen, you hit that first target around 299, 300, and maybe we bounce and we back test that level intra-month and then get rejected and go on down to the next target. But that's it. You can see the white candle shows the after-hour trades. So we're now, since that flag, it just broke down this morning, and we're already halfway down, at least in the after-hour session, to that level. And unless there's a big reversal, I just don't see it tonight. I don't see it tonight. I got, as an active trader, I clipped that first trade this morning, got to hit my first minimum target, got pulled back, profitable on that. Then I went long again to try to game that bounce on the close. It didn't came, gave back the profits on the first one, but I'm right back to where I started as I came into the day. All the, back in the active trading account, everything's back into its little swing niches. My long treasury bonds, long the VIX, short the equity markets, and I'm starting to eye crude oil. It's still long gold and silver, like those pulled back the other day at support. And so I think if we can get rocking on this sell-off and really start to get some downside momentum, because we should, this break of these recent lows should be that point of recognition. I'm starting to see it, at least hear it now, and a lot of folks, they're starting to realize. I call, it's another term I made up. Point of recognition is where, typically referring to bulls and dip buyers, where they realize, hey, that whole buying the dip thing, it's just not working so well anymore. It worked great, since COVID hit. You buy the dips, and even if your timing wasn't right, you get bailed out. That's the nature of a bull market. There's an old saying that says, never confuse genius on your part with a bull market, because you can be an abysmal market timer. You can be, you could be buying this high and then buying that high. You can be buying all the highs, and a bull market's going to bail you out, and a bear market's the other way around. Instead of buy the dips, if you're really, timing using 60-minute charts and everything, you're buying these dips in a bull market. But bear market's just a bull market in reverse, turned upside down, and that's what I've been talking about for weeks and months now. Sell the rips, cover the dips and sell the rips. Or just, again, I speak also, that's active trading stuff. To a swing or trend trader, sit tight. At this point in time, all I'm trying to tell you, it looks good. Usually after hours, it could go either way. But yeah, I'm watching them. And then they all, after Alphabet started selling down, Microsoft is now fading some of the lift that it had right here. See, that's selling off. And then Apple, Apple, what Microsoft does, and Alphabet really should have no bearing on Apple, but it does, because these guys are interrelated. Live by the fangs, die by the fangs. In other words, outflows. These are fund managers, growth fund managers, momentum fund managers, realizing pension fund managers, hey, whoa, something's going on here, and they're starting to sell, and they're either selling the individual stocks or they're just selling the stock futures, the indexes, however they're invested there. And if you sell your QQQ or short QQQ or NQ, you're pretty effectively you're proportionally not proportion yeah proportionally to their weighting selling those components of the Nasdaq 100, or those fund companies are doing it. So all right, that's it. Not much else to add. Just that looks good. Sit tight on shorts at this point in time, whatever shorts you have, and it's still. Here's the tough part. I made some answers to the comment section before about not getting overly aggressive, and I certainly meant that going into today. I'm upping my short exposure a little bit after what happened today. These two are out of the way, and it doesn't appear that they're gonna save the day. In fact, they're probably gonna cause or trigger the breakdown of those recent lows in QQQ, and I'm talking in the regular session. After hours kind of doesn't count. It does count if it sticks, but after hours trades can be reversed. Anything can happen at night, and something can pop the futures. But if we can close solidly below there, and that's what I mean by putting that in the rearview mirror, then I don't think the rest are going to save. I don't see Facebook's not even moving the needle as much anymore because it's dropped so much. It doesn't have the same weighting that it used to in the indexes. Amazon and Apple, sure, they can move the needle, but their technical postures don't look like they're going to do it. So easiest way to say it is, you can continue, or I'm going to continue to layer in, but you got to watch. If we go down there quick and hit T2, then you're at support. So at that point, you can there's a lot of ways you could try to game a bounce if it looks like one's going to come in the charts, but it could be a crowded rush for the exit, and we could have very little to no reaction there and head on down to that next target. One thing, again, if you're a typical swing or trend trader, you've had multiple objective short entries on both breakdowns off the highs and trend lines, as well as kickbacks to resistance and the moving averages. At this point, it's just prudent to periodically just ratchet your stops down, and again, hold out for those longer term targets. But let me wrap it up here. See how we trade in after hours, see what happens tomorrow morning. But as of now, that's how you have to look at it. As of now, if these after hour losses hold, then we're going to gap down, and then we're going to gap down below those levels on the daily chart, which again, if you put on a daily chart like this right here, there's that big level, big levels right there. That's where we're going to gap down right now. But if I turn off the after hour trades, it's going to show us just right about at that level. So all right, we'll wrap it up and see where we go. And yeah, if there's anything else, I've covered many sectors that stood out to me. Also, if you're trading sector ETFs and adding to your diversifying your shorts, or just concentrating on the sectors with the most downside, this has been one of them, semiconductors, and now we are down 30% off the highs, and looks like it's going a lot lower, especially when we go to the weekly chart. We're coming up on my first target. So here's the thing, guys. So we're at, for example, the semis are about to hit my first target. This is a weekly chart, a little bit below, and QQQ has the potential to hit this week. So we could look at a little more downside and then a bounce here. Hard to say, but we'll keep it up. I'll do these updates frequently and give you my thoughts. As of now, sitting tight, liking what I'm seeing after hours, for the short trades. And if they reverse it tomorrow, or we've got Facebook, PayPal, Qualcomm, and Ford after the closing bell tomorrow. We had GM, by the way. GM, as big as a company as GM is, it's insignificant in the stock market now. It's not going to move the needle like it used to. It's I use this loosely, but it's only a 57, less than a $58 billion company. Well, why did I say only? Apple is a $2.7 trillion company, and these indexes, the ones we're trading, the S&P 500, the Nasdaq 100, are cap-weighted indexes. It takes a much bigger move in General Motors to move the needle, percentage gain or drop, than a stock like Apple, and that's why I spend so much time focused on the FAANG stocks and the tech-heavy Nasdaq 100, which is just has a concentrated weighting of those. All right, guys, I'm going to wrap it up here, get the video out to you, and we'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great evening.